Very good morning, everyone. Let's quickly take a look at one detailed problem for mergers, which has got a chance of coming in MCQ as well as descriptive. Because if you noticed in September 25, there was not a single question from mergers in descriptive, and only 6 marks came in MCQs. Most likely, you'll be getting a descriptive this time, but to be prepared for both sides, this of the patterns is recent time. The following information is provided relating to acquiring company E Limited and the target company H Limited. The number of shares, market cap, P ratio, reserves and surplus, and promoters holding of E Limited and H Limited is given. The board of directors of both companies have decided to give a fair deal to the shareholders. Accordingly, the weights are decided as 40%, 20%, 30% respectively for the earnings, EPS, book value, and market price of shares of each company for swap ratio. Calculate the following: the market price of share, earnings per share, and book value per share, swap ratio, promoters holding after acquisition, and EPS of E Limited after acquisition, and expected market price of and market cap of E Limited after acquisition, assuming P ratio of E Limited remains unchanged, and free float market capitalization of the merged firm. So fairly nice question and a detailed question. Let's quickly check out how we have to proceed with the answer. So market cap is given, number of shares is given, and then market price can be arrived using that, and market price into market price divided by your P ratio will give you EPS, and then with a number of shares is there and EPS is there, so you can arrive at earnings after tax and share capital and reserve and surplus. So the total will be profit plus share capital plus reserve and surplus will give you rupees 800 lakhs, and book value per share can be arrived using this total divided by total number of shares, that is 800 by 20, that will give you 40. So up to till here, if you compare, maybe 2 marks or 2.5 will be rewarded. Then now calculation of swap ratio. So the 40%, 25%, 35% is given. Be very careful with this. So and now the total is 2.5. So swap ratio will be every 1 share of H Limited to issue 2.5 share of A Limited. So total number of shares to be issued is 15 lakhs into 2.5. That will give 37.5 lakhs. Most likely you will get numbers as 0.75, 2.5 and 1.5 like that. So if you get any other odd number like 0.93 something, then maybe you might have gone wrong somewhere, so you can use it to cross check your answer. And promoters holding is 9.5 lakh plus 10 into 2.5 into 25. So this will give you 34.5 lakhs, that is nothing but 25 lakh plus 9.5. So promoters holding percentage is 34.5 by 57.5, that will give you 60%. Again, this also you can use it for cross checking your answer. This will be 60% or 70% as the case may be. It will not be 63% like that. You can use this shortcuts to re-verify your answers wherever you are required if you feel you are not correct. And calculation of EPS after merger is total number of shares is 57.5 lakhs. So EPS is total profit by number of shares. So profit we just saw above for both the companies. So if we do that 400 by 57.5, that will give you the EPS post merger as 6.956. Now next is calculation of market price and market cap after merger. So expected market price is EPS into P ratio will give you 69.56 lakh. 69.56 per share, and market cap will be 69.56 per share into 57.5 lakhs. That will give you 3,999.7 lakhs, and this is important. If you round it off to the nearest, that will give you 4,000 lakhs. So now FFMC is 69.56 into 57.5 into 40%. We just saw about 60% is promoters, so that will give you rupees 1599.88 lakh rupees. So this is with regarding to the question 19. If you see, it looked slightly tricky, but once we started solving, it was very easy. So that's how the mergers is, and that's how AFM is. So once you start going, it will be very easy for you. Hope all of you follow, make full use of it. All the rest, keep your investors, stay focused.